if I could just, I guess if I introduce myself, my name's Ben Lofthouse, and I have been at Henderson since 2004, running global equity income funds since just after 2006, and we launched Henderson International Income Trust in 2011, actually. So we've definitely seen a few cycles here, and we run some investment trusts, which you mentioned earlier, investment trusts. We run some here that have been around for a very long time, well over 50 years, and actually have got a long history of raising dividends for over 50 years. And I guess that was what we modeled the Henderson International Income Trust, was really to have an ambition of, if you lock your money away in a trust, you come back to it later, and actually it's kept you keeping up with inflation over that time. So that was really where we came from in our history. In this presentation, I'm going to just have a look at kind of over time what we've achieved, what's helped us achieve that, and I guess the importance, I think, linked to the previous presentation of being global, particularly from an income point of view. If we go to page 2 here, I think you can see here in terms of the, here we go. There we go. Can you see that? Yeah. So you can see here the terms of the trust. What we're looking to do is help provide you, the investor, a solution for somebody seeking consistent growing dividend and potential for capital growth. And we're really aimed at diversifying UK investors. And I'll touch on the importance of that shortly. But we don't hold any UK stocks. And we were designed that way, not because we have anything against UK stocks, but because of the concentration in the market. I think what we're looking for are industry leaders at attractive valuations. We've probably got more of a value bias than the previous speaker, and we very much have used the flexible strategy of the trust to help us achieve our income goals. Whilst I've been here over the years, we've seen a number of different mergers for the company, and we've seen a number of different teams join the company. And so I think the idea of global research is very core at what we look at. We don't have any passive funds really at Janus Henderson, and so we really do live and die by kind of active decisions and investment decisions. In terms of the UK, I think it's important to understand for people, it's a great market from an income point of view, but it has quite a lot of concentration within a number of different key stocks and sectors. The oil sector, the banking sector, tobacco sector, and the mining sector all make up large parts of the UK markets. And you can see on the left-hand side of this, just in the last year, over 50% of the income has come from 10 stocks. And really the point there is, you can own quite a lot of different UK funds, but because of the concentration in the index, you may well end up owning a number of these areas. And actually, whilst they have high yields, 4 out of the 5 of these on the right-hand side in the last 5 years, have actually rebased their dividends. And so, the pitch for launching Henderson International Income Trust, or HINT, was that you can have UK and we can do something completely different where we won't have overlap with you. So, if the worst things happen to some of these, you won't have to worry about them within the trust. I think the history of the trust here, you can see over the time, we launched with a 1 pence per quarter, so 4 pence dividend. We've grown that dividend kind of through thick and thin, whilst for a lot of the period adding to the reserves like you spoke about. So actually, just over a decade later, you're getting 50% more income. Personally, myself, with my holding in HINT, I reinvest that income. So I look to buy more shares, and that was, as you said earlier, that happens kind of automatically sometimes for me. But other people, for them, it's an importance of, if they're drawing down on income, regardless of whether the market is up or down, they like to see that income growing over time and keeping up with inflation. So overall, it's been 6% growth per year. The dividend was 98% covered last year, and so that means that the underlying income from the holdings provided a lot of the dividend cover. And so it's not necessarily generated from distributing capital or selling companies to be able to pay out that dividend. It's very much generated from the income underlying. The reason we're able to do this is because of the characteristics, I think, of a lot of the different sectors in the world. These lines you can see moving across your page represent the outcome of a proprietary study we've done at Janus Henderson. It's run over a decade now, so it started in 2009 after the financial crisis. And what we thought as well, we know what stock markets do each day. People can report on that, but how good are companies at delivering investors and their shareholders actual cash? Some of the surprising things that have come out over time are some of the higher yielding areas that you might think of, such as utilities, have not been very good actually at keeping up with inflation. You can see the orange line down the bottom here is the dividend coming from a group of global utilities, and this is just the payouts that they've paid every year since 2009. You can see you're getting about the same payment as you were over a decade ago. So it may have been a high payment then, but you're not really getting very much growth. On the other line in there, you can see his basic materials is the kind of black line there. So mining, again, it's been up and down over time, but it's been cyclical. And so again, some years you've got more, some years you've got less, but it hasn't really grown over time. What you can see here actually, which is a bit of a surprise for people, is the technology sector has grown significantly over the period. The healthcare sector there has grown significantly. That's the kind of maroon line. So what we're really showing here is you can access different streams of growth outside in global markets than you do get from the UK, where you'll get more utilities, oil and gas type growth. In terms of, I guess, where we are in the cycle, I'm always wary to kind of look and try and predict the future, because often it's not how you think it's going to turn out. But I think what we can look at are valuations to say, well, what do people think is happening and how confident are people? And I'd say for the life of the trust, we've tended to trade at a discount of around 2% for a lot of the trust's life. We traded as a premium. And more recently, we've been trading at a discount of around 9–10%. A lot of trusts have been trading at discounts. And I think that's reflective of the uncertainty people have about the economic outlook. You know, as a result of that, the trust yields around 4.5%. So that the aim of the trust was very much to provide UK holders with a similar type of income that you'd be getting from a UK portfolio. And actually that's slightly higher than UK portfolio now because of some of the cuts in recent years. In terms of the valuation of the portfolio, one of the measures that people look at is price to earnings ratio. You can see here, currently we're on 12.5 times price to earnings. So that's how much you pay for each unit of earnings in the portfolio. And what does that really mean? Well, actually, it's relatively low. So in the 5-year history, and let's, we can say the last 5 years have been quite tough with the likes of COVID and inflation and interest rates. Even though we've had recovery from a lot of that, the valuation of the portfolio is still trading well below kind of the 5-year average, which I think gives me some comfort that there's good potential there for both capital growth and earnings growth. If I kind of think about where that's coming from, I think what's surprising about the current environment is that you can see here we're quite widely spread across a range of sectors. So you can see we've got significant weights in areas like healthcare, quite significant weights in areas like financials. They're both attractively valued. They benefit from different things. So healthcare, pharmaceutical companies and medical device companies in some cases have traded weakly because of some of the COVID trends. So actually some treatments people weren't able to get during COVID and the sector's sold off. And what we really look for in the portfolio are companies where they're market leaders or industry leaders, but where the market or investors are currently maybe a little bit more uncertain about the future than they were in the past. But we think actually the returns of the companies and the market positions are strong. The financial sector is interesting because actually not all companies did very well over the last decade, but they've been struggling with a very low interest rate. And for many companies, the interest rate being low causes problems, particularly in financial services and banks, because they are able to make less on the money that they have. But actually, we've seen interest rates rising. And one of the attractions of having exposure there was that many companies were doing very well, even when rates were low. And actually, the dividends, which represented very high dividends because people were uncertain, have been kept and grown, and we've seen share price appreciation in that area. So that gives you, two examples of two very different sectors that are both in our case, attractively positioned, but both have very different drivers, and so they provide diversification. One of the advantages of being global is that we are able to diversify sectors that might have some sort of regulatory involvement, and that's important because, as we know here in the UK, regulators, they react to crises, and sometimes they can bring in new rules suddenly. Sometimes, for example, specific things can happen in a country suddenly. We've seen more recently problems in China around property. If you're a single country income fund, or even a single country or region fund, it's very hard to kind of be able to diversify those types of risk. We've seen quite a lot of that in the UK at the moment, with utilities getting a lot of attention because of some of the practices there are perhaps not ideal. What we try and do with the trust, and what we really emphasize, is we're able to diversify some of these risks. And so I think, similar to in the introduction to this, it's not necessarily the right thing to buy the highest yield, but also it's not necessarily the right thing to put all your eggs in one basket. And so having diversification is very important. On the left-hand side, you can see the diversification from geographic weightings, ranging from North America there at 39%, Europe at 36%, and then a good exposure to emerging markets and to Asia Pacific. The next few slides, I'm really going to dwell on, I think, what will be the drivers potentially, or some of the drivers of growth going forward. Because I think, we spoke initially, it's fine, you can get 4% yield, but you can get 4.5% yields, 5% yields on bonds at the moment. What is it in this environment that equities can give you? Well, one of them, from an international point of view, is exposure to fast-growing economies. So you can see, although we've got quite a developed market weighting, and we provide that provides good governance. We find good management teams, good companies that have been around a long time. Actually, a lot of the growth here in the portfolio and a lot of the revenues, we've got 34% in North America. Actually, when you add up Asia, emerging markets, developed Asia, you're getting towards over another 40% there. And one of the attractions of these areas is, they've got quite attractive demographic growth, less debt in the governments, and some real market and industry leaders. So although we're quite a developed market focused fund instead of in terms of listings, we do have a lot of growth coming from other parts of the world. The other thing I think that's really important is the idea of positive drivers underlying. And I think maybe where our view differs from some others at the moment is we see technology and technological innovation broadening out significantly around the world into different industries. What we've listed here are some of the key drivers. And why is it important to focus on this? Because we're less focused on whether interest rates are higher or lower, what government is in, or what the next thing is going to happen to from an electoral point of view. What we're really looking at is, well, what are companies telling us that they're focused on for the next decade? One of the key things we're seeing is an enormous push towards electrification. For a while, people thought the only way they could access that was to buy very niche products that were completely focused on, say, renewables or wind power. And actually, we believe many of the answers of tomorrow will be provided by the big companies of today. So the utilities, in terms of the energy grid, we need a massive investment over the next 10, 15 years all around the world to be able to achieve the goals we want in terms of decarbonisation. That means heavy investment in the grid, heavy investment to connect renewables to the grid. We need to have charging, electric car charging, and that's before you even get towards industrials trying to wean themselves off fossil fuels. So companies like Enel and Iberdrola, which are two large utilities, actually have spent the last 15 years shedding some of their coal assets and increasingly investing in renewables, and increasing the governments in the countries that they operate in, which include Latin America, which include the US as well as Europe, are kind of looking for them to help provide us the answer. So for us, these are groups of companies that will see more growth in the next 10 years than they have in the last 10. I think that's one of the things that people are not necessarily seeing. The other thing mentioned earlier by the previous presenter was technology. In Asia, we have some of the global leaders in technology, companies like Taiwan Semiconductor and Samsung. And one of the things we found actually is the product of 10, 20 years of investment and consolidation means that many of these large companies are producing the technology and are able to invest heavily enough to invest the technology that really are going to drive AI and AI adoption. And included in that, they're going to see more content involved in cars. We've all, I'm sure, have seen our cars become more technologically advanced. So these are just some of the things I think where we would see that the market is, they're preoccupied with analyzing macroeconomic activity, but when our teams of researchers meet these companies, actually we're finding they're much more positive about long-term growth. They don't know what's going to happen in the next 6 months or 8 months, but much more positive about long-term growth than they might have been 4 or 5 years ago. I'll just say here, one of the things I said, I wouldn't try and predict macroeconomics, and I don't have any macroeconomic slides. I think one of the things I've learned over the last decade is, in terms of, these events that we've seen, China slowdowns, US rates going up, the pandemic, these things, in many cases, were unforeseeable. And the key thing is to keep being able to grow net asset values and company values through these over time. One of the things that allows us with investment trusts to perhaps enhance these returns is the use of gearing. So Henderson International Income Trust has entered into just over 20-year facilities in 2019 in euros to try and lock in cheap debt. So we're not seeing our debt cost rise. And down the bottom here, at the bottom of this chart, you'll see there's a line there which is on the right-hand axis where we show gearing. And so sometimes the trusts use up to 15%, 16% gearing. We can go up to 25%, no more. And we tend to own, very conservatively run companies without too much debt. And what this gearing allows us to do when we feel markets are cheap is to be able to invest a little bit more counter-cyclically to help generate higher returns through time. You can see at the moment, actually, we don't have very much gearing. So, despite markets and the price to equity being cheap, I guess we're a little bit wary about what might happen over the short term with interest rates going up. But as I said, what we really want to do is keep dry powder to invest in these companies that are going to help solve our future problems. In terms of the firm, just to finish on this, I've been here since 2004. I've seen a lot of change over the time, but a lot of the core fund managers have been here for a long, long time. And what we've seen actually is we've moved from being quite a UK-centric company to a much more global company. We've got a big team of researchers and fund managers in North America now. So, that's something that we definitely didn't have 7 or 8 years ago. We've got teams that focus on technology, real estate investment trusts, pharmaceutical sector and biotech. So we have these thematic teams as well. And really what my team is doing is dipping into all of these, talking to them and trying to find the best global income ideas that we can find for investors to help achieve their aims over time. So just to conclude, an investment solution for UK investors, designed for UK investors, to provide a growing dividend with potential for capital growth. Industry leaders, attractive valuations. We do use the investment trust tools, both in terms of smoothing dividends via reserves and in using leverage to help enhance returns over time, provide certainty. And we use the extensive Janus Henderson sector and local knowledge to help achieve objectives.